China produced 473 million tons of crude steel from January to May 2021, a year-on-year increase of 14%. Based on the data above, the full-year production is expected to reach 1.14 billion tons, an increase of 78 million tons from last year. In April, the average daily crude steel output hit a record high of 3.26 million tons, while the highest level last year was 3.09 million tons. In May, the average daily crude steel output remained high at 3. At the forecast of steel and iron ore prices for the second half of this year, as domestic crude steel output and the supply remain high. Demand will decrease slightly in the second half of this year. We believe that the average steel prices will move down in the second half of 2021, and the price of iron ore will also be affected. Taking Shanghai market as an example, we expect the full-year average price of rebar will be 4,800 yuan per ton. The average price of hot-rolled coil will be 5,100 yuan per ton, and the average price of imported iron ore will be $160 per ton.
With or without the pandemic, you can see ASEAN export out of the region is on the rise, almost every year since 2016. So where do the rise come from? The rise came from mainly a few countries, mainly Indonesia and Malaysia, right? Okay, and what is interesting about this particular slide too is that the increase in exports came together with the increase in capacity, right? For example, in 2016, you have new plate capacity coming up, so therefore plates were exported. Also around that time, you see a lot of stainless steel coming in. All these are also exported. Similarly, for Malaysia, you have a new capacity of long products coming in, and the moment it came in, it was also exported. Vietnam's case was the same. Hot rolled coil capacity of 7.5 million ton came in sometime in 2017-18, and of course, the volume was exported. So it's interesting to note that all recent investments are needed to export.
So yeah, clearly, Chinese steel production growing quite strongly, as we've heard already. But at the end of the day, the underlying demand conditions are perhaps not as strong as a lot of people think they are. I mean, it's quite clear that the inventory builds have been unseasonably high, even with the backdrop of supposed steel disruptions at the margin in terms of environmental clampdowns, etc. And of course, we've got extremely strong steel exports. And that, in my mind, is the real driver of the steel prices that we're seeing in China today. It's not domestic demand, it's export-driven demand. And that, in turn, is supporting the iron ore prices through the incredibly high steel margins that we've seen in 2Q. But the steel inventory is where the real story is there. You can see normally, again, on a seasonal basis, that post-Chinese New Year surge in construction and general economic activity through to the peak in the middle of the year. That normally means steel inventory draws at an incredibly fast pace. Now, you look at these charts here, they don't look too different to normal, but certainly just from May onwards, most of them have been rising. So steel inventory has actually been increasing since early May, when normally it would continue drawing until June, and that is with the backdrop of surging steel exports as well. So that's just another indicator that actually the underlying demand conditions perhaps not that strong, and certainly not justifying such extremely high steel prices that we've seen.
So the macroeconomic environment continued to be favorable for commodity prices this year. China's PPI for May surged by 9%, the highest since 2008. However, CPI has yet to see significant rise yet, thanks to administrative interventions. So now back to ferrous. China's steel sectors has been expanding on top of record crude steel production last year. Crude steel output during January and May registered a 15% increase compared to the same period last year. Steel exports posted an increase of 24%, as well as steel demand recovers in the rest of the world. As Mr. Roper mentioned, this is a big driver of steel prices this year, the steel exports, even after the rebate cancellation.
A difficult question because it's looking into the future, but whether our CEP comes or not, it doesn't really matter, all things being equal, because the import duties and all those rates between the ASEAN countries and China have already remained very low as far as steel products are concerned. So that's point number one. Point number two, will China bombard ASEAN countries with steel? In the future, the answer is it is possible. But again, if China is going to reduce capacity in China, then it could be more opportunities for the ASEAN steel mills to export to China, as what has happened in the past 1 year, right? And export to China or from China, a lot depends on economics, right? So, and as of last year, where we saw a lot of export from ASEAN to China, it was because the ASEAN products were more competitive compared to the local domestic products. So that's why it happens. So it depends on economics.
So yeah, the steel mills will just buy whatever they need to produce the steel if they keep making money. So at the end of the day, it's the steel margin is the important issue. And the steel margins are very much being supported by the export trade. It's nothing to do with China's domestic situation. Demand is clearly slowing. There is plenty of steel being produced. As we know, steel production's up strongly. Despite the talk of all these environmental controls, that's very marginal in reality. The strength in Chinese steel prices is because steel prices in the rest of the world are so strong, and therefore the exports are so strong. So China is trying to cool that down, the rebate cuts potentially with steel export taxes, but the spreads are still extremely wide. So Chinese steel prices are being supported by the exports, and that in turn means steel margins are good and the steel mills want to keep producing, so they keep buying iron ore. Whether $200 is a fair price for iron ore is very debatable. You know, economics tells us iron ore, you know, any market price should reflect the marginal cost of supply. Do we need to incentivize supply, or you're rationing demand because you run out of supply? Neither of those factors count for iron ore, right? The highest cost iron ore supply in the world is probably about $130. You can economically turn mud into iron ore. Don't forget the Earth's crust is 4% iron. You can turn mud into iron ore for less than $200. So we have essentially an infinite supply curve. And equally, iron ore port inventory, as I said, is not running out. We're not running out of iron ore. There is iron ore supply there. It's just, yes, there is not very much high grade. There's not much lumps. There's not much pellets. Steel mills are making a lot of money and they're desperately scrambling for those high grade materials. But so, yeah, there's a lot of froth in the iron ore market. You know, the price could easily be down at $130, and I wouldn't change any of my views at all. So there's a lot of froth in the price, no doubt, but that's been the way for many, many months now. So trying to pick a trigger, why is it going to go down and how far is it going to go down?